Thank you very much, Masood Ahmed, for the clarity of your observations. Actually, your insight will be highly invaluable to nurture the following panel discussion, which will focus on business models of the public development banks in a rather complex and uncertain world. And for that, we have a brilliant panel again today. So please welcome Ms. Sherry Spiegel, who will lead the panel discussion. So Ms. Spiegel is Chief of Policy Analysis and Development at the Financing for Sustainable Development Office from the UN Department of Economics and Social Affairs. Hi, Sherry.
Hi.
It's good to have you here.
Good to see you.
It's great. So as you can see, all the panelists are there, and to share the insights on the topic, we have today 5 prominent actors in the field of development. Stephanie Griffith-Jones, Financial Markets Director at Columbia University. Hello there. We have Bruno Cabrilec, Deputy Director General of Economics and International Relations for Banque de France. We also have Sergio Guzmão-Szydlowski. I'm sorry if I got the name wrong. Sorry about that. Chief Executive Officer of the Development Bank of Minas Gerais, BDMG in Brazil. Nancy Lee, the Senior Policy Fellow at CGDF USA, who will address her message in a recorded video later on, and Serge Ekwe, the President of the West African Development Bank, the BOAD. So Sherry, over to you.
Hi there.
Great, thank you so much, and it's really an honor to be with you. As has been discussed in today's meeting already, development banks play an important developmental role, and particularly including in achieving the SDGs. They are important for the provision of public goods as well as playing a counter-cyclical role. But unlike commercial banks, public development banks have really two different aims. One is the mandate of developmental impact, and the second is that most development banks also need to have financial sustainability. This means that they have to have a different business model. Instead of just maximizing risk-adjusted returns, they need to look at both risk-adjusted developmental impact and risk-adjusted financial return together. As Professor Stiglitz said this morning, there have been many innovations in finance that development banks can use to achieve their goals, but many of these also can create new risks. And so this panel is really meant to look at what are the different business models for development banks. How are they different? What is the business model for development banks? How is it different from commercial banks? And what types of instruments can development banks use and under what circumstances? And this is not just in regular times like in normal times, but also in crises such as COVID. As was discussed in the last panel, actions that are taken today are going to. And so how can development banks address short-term needs as well as contribute to sustainable development in their actions? And what lessons can we learn from the crisis for business models going forward? As we just heard from Asha, we have a really excellent panel today that includes both academics, practitioners, and as well as practitioners from development banks who work on the ground. And so as a background for this paper, as part of for this panel, as part of the research project that was mentioned this morning, I worked on a paper together with Stephanie Griffith-Jones, Xiaojun Chu, Marco Carreras, and Natalia Nakvi on matching risks with instruments in development banks. And I'm going to pass, the first speaker will be Stephanie Griffith-Jones from Columbia University. And Stephanie, hi, good morning, or good afternoon. And the questions for you to think about in this context would be, the COVID crisis has highlighted the importance of risk management, and this includes both financial risk management, but also the risks for development impact. How can development banks best manage both financial risks and risks to development impact, and what types of instruments are most appropriate for addressing both types of risks?
Thank you very much. Thank you very much. Delighted to be here. As Sherry said so clearly, development banks have two aims. One is to maximize development impact, and therefore a risk which development banks face is that they do not maximize the sustainable and inclusive development impact. And that is perhaps the main risk they face. And the second aim is to be financially viable. So though it is a secondary aim, these banks should be profit-making, but perhaps not profit maximizing. And in that sense, they are different from commercial banks, which have only a short-term profit maximizing role. In our research, we saw that certain types of risk are positive for development banks to take. For example, as regards the real economy. And Mariana Mazzucato mentioned the missions, the big innovations, the big sectoral changes that development banks need to support. And this means, for example, financing innovation or financing the introduction of innovative technology, often with very important positive externalities, particularly for development. And a good example of that was the initial introduction of solar or wind power, where development banks, particularly in Germany and China, really led the way. Other risks that we want development banks to take is, for example, lending to poorer regions, to poorer people, to poorer countries, or to the initial phases of infrastructure projects, the construction phase, which has much more technical and geological risk. And so this kind of economic risks, which are desirable, is different from financial engineering risks, which is originating mainly from the form of financial instruments used. I mean, financial engineering can have positive effects, particularly attracting and leveraging additional private financial flows, which is, of course, desirable. However, the use of these instruments can also risk redistributing risks excessively from private actors to the development banks. And ultimately, the risk of contingent losses would have to be borne by governments and their taxpayers. So ideally, we think development banks should try to maximize development impact while minimizing financial engineering risk. And I think one of the conclusions of our paper and of the program is that an alternative or complementary way to ensuring a greater level of activity by development banks is to increase their capital, their paid-in capital, as was done at a major scale in the wake of the 2007-2009 development crisis, financial crisis, sorry. And it would again be very useful in a period like COVID-19, because there is so much general uncertainty, and the private sector on its own tends to be very unwilling to lend. And therefore, an increase in capital would allow increased level of transactions, as well as allowing development banks to continue taking the risks that are key for development without increasing excessively contingent liabilities or lowering their credit rating. And therefore, I think it is urgent and actually to have a significant increase of capital of the MDBs, the RDBs, and the national development banks. As I said, both to increase COVID financing, so necessary at the moment, but also to maintain the orientation for the major structural transformation to a green economy and an inclusive economy. And finally, on this aspect, we feel that those countries that do not have development banks, it's very important for them to create one. And as regards to your second question, Shari, what are the types of instruments that are most appropriate for different kinds of risk? The sort of bread and butter instruments are loans, which are the ones that are mostly used and very valuable. They're normally very long term, as Joe Stiglitz mentioned. But it's interesting that development banks have been flexible, and in the COVID crisis, where a lot of companies have a lack of working capital and have difficulty paying their workers and their suppliers, development banks have shifted with great flexibility to also lending short term. And these loans can be both direct or first tier, which is probably better for major projects or key strategic projects, or they can be second tier or indirect, which is probably better for smaller projects and those in distant regions where information asymmetries are bigger and where you can have either a commercial bank or a subnational development bank like the one that Sergio heads. A second type of instruments are guarantees, which according to the literature are particularly valuable for moments of great uncertainty, again, like COVID, or also when financial markets are undeveloped. But we need to consider that they have a potential cost to taxpayers, especially if they're not well priced. And as Greenwald and Stiglitz have pointed out, if there is not an informational advantage to development banks over private banks, there is not, from a welfare point of view, an advantage to use guarantees, and perhaps it's better to do more direct lending. But they are, as I said, very important for times of great uncertainty. And finally, there is an instrument that I think is very important and which perhaps development banks should use more, which is equity, both direct and through diversified portfolios, because that has one of the many advantages it has is that it can capture the upside of potential profits, sharing not just the risk, but also the profits with the private sector. And I think it's particularly suited again for innovative technology to high-risk projects with potentially high development impact and high profit potential. So I think what we also concluded in our research in this and other papers was that there is need for further research. I'm afraid academics tend to do that, but one of the particular areas of further research is equity itself, but also how these instruments are relevant or should be adapted for countries with different levels of income. High income, middle income, or low income have different needs for different, and therefore need instruments that are different. And also how they should be adapted to different sectors, to innovation, to agriculture, to industry, to infrastructure. So thank you very much for the opportunity. And I look forward to
Thank you so much, Stephanie. I'm going to go back to your point on how many of the development banks have used this moment to increase lending working capital loans and short-term loans, to really as a segue to our next speaker. So Mr. Cabriac from the Banque de France, if you could talk a little bit about counter-cyclical instruments that could help development banks maintain a counter-cyclical role, both in normal times and during times of crisis, such as the current one. And does the current crisis present an opportunity to really increase the use of such instruments going forward? So over to you, sir.
Thank you very much, Shari. Let me do a short flashback on the notion of dual mandate, which you mentioned, and which has been mentioned a lot during the beginning of this conference. Well, as the public banks, particularly the national development banks, they did not prove to be the best performer in terms of credit allocation, at least in terms of maximizing short-term profits. It's really important to assess how much they fulfill the second leg of their mandate, and to finance a sustainable and inclusive development and address the market failure. So let me just signal a paper from Laurent Wagner, published in the framework of the International Research Initiative on the theme of this conference, which in fact produced, and it's the first time on such a scale, maybe the proof that the national development banks did fulfill this second leg of the mandate. This research paper, using firm level data from 127 countries over the 2006-2018 period, shows that first, the NDB tends to provide more financing in more vulnerable and less developed areas. And second, the NDB play really a counter-cyclical role. So they already do that. So what can they do to strengthen this counter-cyclical role? And as Stephanie mentioned, manage the risk associated to this role. Well, first of all, they can use different tools, both on the liability and on the asset side of their balance sheet. On the liability side, for example, they can finance themselves through contingent debt instruments. For example, GDP, pure vanilla GDP-linked bonds can give them automatic rooms of maneuver to extend lending during downturn. That's quite important, and I'll come back to that answering Shari's second question. On the asset side, counter-cyclical lending is ensuring the debtor against the main exogenous macroeconomic risk is facing. So the AFD is practicing this type of lending, and the more institutions are practicing this type of lending, the more efficient it is. And finally, both on the asset and on the liability sides, off-balance sheet instruments can be used. In fact, it has been mentioned, the guarantee has been mentioned on the asset side. Guarantee can preserve the lending capacity during downturn as risk materialization is generally lagged. On the liability side, benefiting from MDBs or sovereign guarantees allows a transfer of the counter-cyclical power of the MDBs or of the sovereign to the National Development Bank. In the same spirit, you can, of course, recommend the use of option-based instruments. And then, of course, one very important tool to be used by the National Development Bank is tools to hedge the currency risk if they have, because the currency risk is very pro-cyclical. Let me finish by answering in just a sentence to your second question, Shari. Is it the right time to use this instrument? Yes, of course, because there is a big upside risk. So it can be appealing, at least for the investors, for example, to buy GDP-linked bonds issued by national development banks in many, many countries.
Great, thank you so much. And it's quite interesting also to think that if public development banks are able to fund themselves through state contingent bonds, that they might also consider on the asset side lending and including some of these contingencies in their own lending, possibly going forward. That could be, they could be a market leader, as well as especially if they're able to fund themselves so that they're hedged on both sides. But really, thank you so much for those really interesting comments on this. Next, I'm going to go to Nancy Lee from the Center at CGD. And at CGD, you've developed concrete proposals to leverage DFI investments to invest in the SDGs. And could you describe your proposals and how such proposals could help public development banks increase their developmental impact? So Nancy, over to you.
Thanks so much, Sherry. I'm delighted to be part of this conversation. Let me try to briefly describe two ideas, the first of which targets critical gaps in capital markets that are hard to fill by development banks or commercial banks. And the second addresses the challenge of achieving greater systemic or market impact. On the first, we know that development banks collectively mobilize a limited volume of private finance in normal times, about 48 billion in 2018, according to OECD DAC data. And we know that the reasons are understandable and familiar: scarce bankable projects, limited risk tolerance, preference for larger transactions, reliance on senior lending, as has been just discussed, rather than more catalytic instruments. These are not failures of the model. These are really entirely consistent with the financial models of development banks. And that was before COVID. Now we face, I think, a dramatically altered reality. We know that small and medium enterprises in particular, many of which will fail, and we know that they employ some of the most vulnerable people. And in poor countries, there just is not enough fiscal space to support SMEs. And in fact, most of their governments are not doing so. So the focus coming out of the crisis has to be importantly on supporting SMEs with growth potential, including new and young firms. Conventional development banks don't have enough grant finance to sustain firms whose revenues have collapsed, and they're not well suited to the challenge of financing young firms or banks or financial providers. So I would argue we need to give development banks an additional set of capabilities to complement what they already have. And I'm not just talking about more concessional finance for blending. I'm talking about a wider range of tools and skills. And let me highlight 5 capabilities that seem essential to me. The first is the ability to finance early stage firms with limited track records, especially those with innovative business models that will work in the COVID and post-COVID era. The second is the use of subordinated products that fill the capital market gaps. Just as Stephanie mentioned, equity and guarantees. The third is patient investment with long maturation periods and uncertain exits. And fourth, finance in local currency. Fifth, prioritizing mobilization of other people's finance as opposed to volumes of their own transactions. So I would suggest the development bank shareholders should come together to create a purpose-built partner with these kinds of capabilities, and they can build it in such a way that incentivizes cross-development bank collaboration for scale. That's the basic idea behind our proposal for the stretch fund. And the idea is that it would stretch both development bank capital as well as the range of investable projects, and it would be off balance sheet, as Dina was just mentioning. It would bring together risk-tolerant capital, experienced early-stage investors, and purpose-built instruments, and it would target below-market returns or even just preservation of equity. It would offer a suite of financial products that serve young firms as well as more mature firms. So I would suggest that creating such a fund in partnership with the development banks will ensure that any capital increases for the development banks themselves would be more catalytic. And let me just briefly describe the second proposal, which focuses really not just on sharing risk, but on reducing it. MDBs have experience and expertise in helping countries to improve their policies and institutions that directly impact the viability of investments in given sectors. Typically, MDBs condition lending to governments on sectoral reforms, but these loans are developed separately from their project finance for the private sector. They've been trying to do a better job of bringing these tools together, but they have not been able to do so consistently at scale. So I think it's time to create formal processes and agreements that drive collaboration. I'm talking about sectoral compacts, which is a little different than country compacts. They would be formal agreements between governments, the MDBs, both their public and private arms, and local development banks to promote private investment in a particular sector. Governments, in consultation with their private sectors, would commit to specific reforms that make private investment in those sectors viable. MDBs would commit loans and grants to governments to support the reforms. The private finance arms of MDBs and local development banks together would invest directly in those projects. And MDBs could offer concessional finance, such as paying for outcomes, to incentivize private innovations that deliver a defined development impact, like, for example, household access to electricity or water. Private firms would compete for access to those subsidies, and those subsidies could be awarded in such a way that would maximize the development impact per dollar of subsidy. So this three-pronged approach, support for relevant reforms, private project finance, and competitive access to concessional finance, I think would be more successful in achieving systemic impact than just the transaction by transaction approach that development banks tend to use. And I would argue that this approach in this period of exceptionally high risk and uncertainty is not just desirable, I think it's become essential.
Right, thank you, Nancy. Those are really interesting proposals, and really the importance of not just sharing risk and looking for risk sharing mechanisms, but reducing risks as part of the structure is really critical. And then thinking about how do we use development banks and think more broadly in terms of a systemic approach, and how do we use a system to do this these are really critical issues. I'm really interested to see what our next two speakers think of these, and maybe at the very end, after we go through the initial round, we can get some feedback from them on their thoughts on these proposals. I'm going to go now to Sergio Suchodolski, apologies for that, from the Development Bank of Minas Gerais, to talk a little bit about draw on your experience on the business model of a subnational development bank in reaching the poorest and financing the last mile, and also how you've responded to the COVID crisis, lessons you can take from the crisis, and have you been able to link your crisis response to this longer term idea of investing in the SDGs? Thanks.
Thank you, Sherry. It's a pleasure to be with you today. Thank you, the French Development Agency team and my fellow panelists, and a special salute to Professor Griffith Jones, who has been inspiring the development community for so long. BDMG is the largest state-level development bank in Brazil. We are active in 7 different states here in Brazil, and the bank is celebrating 58 years of existence with a concrete experience on the ground and serving more than 27,000 clients. We are present in 90% of the 853 municipalities of our good state of Minas Gerais. So our capillarity and track record has shown a few lessons on how we get things done on the ground. First lesson is that it's imperative to understand and be able to connect our work with the global development agenda. And there I reference the Addis Ababa Finance for Development Agenda, the Paris Agreement, and of course, Agenda 2030. In this sense, BDMG has recently reshaped its strategy and business model, and the core of the transformation is to fully align with the SDGs and the 2030 Agenda, which has allowed us to better measure, communicate our results, and access funding in more adequate conditions. Another key aspect of this transformation has been the combination of a deeper specialization in the territory we finance, and with also enhanced use of digital tools. We actually service 98% of our SMEs through our digital platform. These two elements allow us to improve performance and reach a larger pool of clients on the ground through a more effective identification of investment opportunities and a better connection between local actors and global funds. Powered by partnerships with institutions like the Inter-American Development Bank, the French Development Agency, European Investment Bank, Fomplata, and CAF, new strategy has expanded our operations and related especially to the sectors of clean energy, public health, innovation, and infrastructure, in addition to expanding specific programs and lines for valuing female entrepreneurship and working capital for SMEs. The second important lesson I want to share with you is the need for development banks to expand their activities beyond credit, and especially to become a real comprehensive development platforms. In the sense, we have been active players in project preparation of key infrastructure investments at the municipal and state levels, and we are working in a project preparation facility that will enhance the quality and scalability of sustainable infrastructure investments through effective public-private partnerships. So supporting the state and its municipalities in designing good projects and attracting private capital to expand local infrastructure, we believe is pivotal to generate local impact. Now, regarding the question around the response to the COVID crisis, in terms of our response to the COVID crisis, I would like to use 3 numbers that summarize our programs this year. First, The total disbursements of BDMG in 2020, they are 169% higher than 2019. And we just have surpassed the number of 2.5 billion reais disbursed so far. The total credit for SMEs has quadrupled, and they account for around 30% of our portfolio so far this year. And 50% of these disbursements are fully aligned with the SDGs. This performance is a result of a counter-cyclical strategy based in 3 pillars: well-being and protection of our employees, new financial products and protective measures to the bank's financial sustainability, and it's anchored in the overall strategy that I described before. Since pandemic day one, we have adopted safety and security protocols based on the best available scientific evidence, and we have put more than 95% of our employees at home in less than a week. Also, we managed to rapidly respond to the great increase in the credit demand by launching new emergency credit lines, especially to support the affected sectors and improve the state capacity to deal with the pandemic effects in the health sector. The key point here is that most of these operations, especially with SMEs, were only possible because the bank was prepared both in terms of our digital credit platform and in terms of funding, with an important contribution coming from the partnerships with international development institutions. The third aspect of the response, directly related to our new business models, is the bank's financial sustainability. As some of my colleagues have referenced, we are operating with a mix of 5 different guarantee funds, which allowed us to better allocate the risk of this new portfolio that was constructed during the context of the crisis. And additionally, we have improved our risk models and enhanced the monitoring of liquidity and market factors. In terms of the alignment of the bank's response with SDGs agenda, the most important step of this year was the launching of our sustainable bonds framework. The framework includes categories for social environmental projects that intend to be in line specifically with 13 of the 17 SDGs and 28 of the 169 SDG targets. The framework provides clear guidance on the eligibility criteria for sustainable and social projects, and also includes exclusion of sectors with negative impacts and indications for impact reports. The launching of the framework is a key step for the issue of a sustainable bond in the very, very near future. We are on the last stages for this matter. And this will be the first operation of its kind among Brazilian development institutions. So finally, and concluding, I think that most important lessons we learned in this crisis is that subnational development banks like BDMG have a meaningful contribution in the global effort to make finance work for the transition to a more sustainable development pattern, and therefore should be empowered and better integrated to the global development community. In this sense, it is important to update the current global development finance architecture, in particular the Addis Ababa Agenda for Development, to fully acknowledge their capacity to mobilize resources and implement development programs on the ground. Finally, my last point, and it's just a comment on Professor Griffith Jones, we were able to receive the first capital increase from our shareholder. We have asked and have received green light in over 2 decades. And this has allowed us to really be successful in this major increase of our disbursement during the pandemic. I will stop here. Thank you so much.
Thank you so much. It's really fascinating to see what you're doing, and really, uplifting to hear the efforts you're making and the progress you're making. When we were discussing, so much of the discussion at the UN right now is how we're off track to meet the SDGs. And so it's really wonderful to hear the efforts being made on the ground to actually align work with the SDGs and to really make the SDGs to move them forward. And in the Addis Ababa Action Agenda negotiations, national development banks were brought in for the first time into an international agreement. And at the time, I think there was a lot of skepticism. It stayed in the agreement, but there were a lot of questions as to what their role would be, and skepticism even as to their ability to really contribute. And so I think that 5 years later, to hear what's happening on the ground is really wonderful. For the next example, we're going to go to Sergey Eku, the president of the West African Development Bank, to hear examples from your side as to how your bank has responded to the COVID crisis. What instruments have you used, and what lessons can you take from the crisis? And will the operations more recently affect how you operate going forward? So really over to you to talk about your experiences on the ground. Thank you.
Sherry, thank you very much. I'll try to wrap it under one and a global answer. First of all, the West African Development Bank is the common development finance institution for 8 member countries of the West African Economic and Monetary Union, namely Benin, Burkina Faso, Côte d'Ivoire, Guinea-Bissau, Mali, Niger, Senegal, and Togo. We've been, on the cumulative side, we've been supporting these countries from inception for roughly 9 billion euro. Now, the question you're asking is basically related to this COVID, which is nothing else but an exogenous shock. But basically, we could face other shocks. All right. So the answer to your question is to which extent our balance sheets is resilient enough to either endogenous or exogenous shocks. So the COVID crisis is putting under scrutiny the adequacy of traditional instruments used by MDBs, the firepower of these institutions, as well as their ability, agility, and responsiveness. So let me try to answer to the question you have answered. You have to the question you brought to my attention with 2 perspectives: short-term and long-term, to make it easy. So the short-term perspective is kind of easy in the sense that the response we've been bringing to the market is based on the idea that cash is king. At the end of the day, cash is king. So our response was to be quick and, I believe, effective. The financial package, which is the direct financial support for West African Economic and Monetary Union member states and project financing, was based on, first of all, concession loans to each member states, up to, it was a 18 years maturity, door to door, with 5 years deferred and an exit rate of 2.75%. And another, on the other hand, with a 100 billion program in refinancing line to local banks intended to stimulate the economic activities of SMEs. On the mobilization side, a financing agreement signed with the AFD for 100 million euro. Again, the question here, the short-term response, immediate response, as you have seen, was based on the idea that cash was king. Cash being king, so the way we have answered that, we have answered to our immediate response was, first of all, how to mobilize assets, how to ensure swap lines or repo lines. Again, that's the idea of how can we have more agility in the management of the balance sheet, how to secure permanent/ultimate access to central bank liquidity. Again, this idea of cash being king. So on the mobilization side, we have an observation I have to make at this point in time, which is, African country in general, West African country more specifically, have a few difficulties, are not able to get financing at affordable costs, which leads to this debate about the debt sustainability challenges. Now, what are the solutions? The solution here, again, on a long-term perspective, but it has been alluded here by a number of panelists here, is the question of the Tier 1 capital, how to raise capital, Tier 1 capital, which would lead us using the leverage ratio to tap the debt market, which is a tremendous market. The debt market, senior debt market, has been very active. And if you look at the results and look at the commercial bank, investment bank are currently publishing their quarterly results. 2020 is going to be a hell of a year when it comes to debt capital market. Senior debt capital market is going to be a tremendous year. And the reason is there is the need for sustainable, reliable, tangible project, but the liquidity is there. The hell of liquidity is there. So the question is how to mobilize this liquidity. So first of all, so the question of raising Tier 1 capital is one of the answers. The second one, which is, I believe, a very smart answer, is the question of the guarantee issuance, which changed the scope of doing business now, which is no longer let's knock at the door of the World Bank, but let's ask the World Bank, but could be the World Bank, the IMF, or any AAA rating institution. So let's now knock at their door, not to raise funding, but for issuance guarantee. In such a way that they could absorb first loss, or in a basket, first to default losses. So the question is more how to increase the importance of instruments there will be included in bond indices. As an example, Benin Republic has been working on such transactions, and we believe that these are the smart ways, innovative ways of doing business now. Question again of issuing of social development bonds to provide investment that have a social impact while enhancing transparency in the use of funds. Well, you have, as I mentioned earlier, this profound and intense, deep senior debt market. But in the same time, we also have what I call the dedicated fund market, either eligible for green, climate, etc. The market is there, the demand is there, the offer is there as well. Working with foundation or NGOs on debt swap instruments. This also could be an area to look into. We do believe that, again, innovative ways of answering the question you have asked us. Designing in the same way a tailored instrument, enhancing partnership as we have recently done in Austria, with the Development Bank of Austria. Again, dedicated fund, allocated fund to project with a very strict reporting. On the allocation side, when you look at things from a holistic standpoint, we do believe that, let me quote the Infrastructure Consortium for Africa, we have a gap like $100 billion gap financing on a yearly basis. And we know that if we sum up all the balance sheets of the different banks in the continent, that will never be enough to fund this gap. So we do believe in solutions like ensuring greater additional and complementary between MDBs, moving away from a competitive landscape to foster greater cooperation. We strongly believe that securitization would allow credit organizations to benefit from liquidity without refinancing. We believe that adopting a sectorial approach by targeting either underfinanced or strategic sectors could be also a solution to the question you have raised. Thinking out of the box and creating together new innovative tools, for instance, for the informal sector, which would represent a large share of the economies in the region. Last but surely not the least, do have one more minute, Sherry.
Just one, because we want to get to questions.
Just one. Yeah, we have just launched our strategic plan for 21-25, which is called Joliba. It is a way for us to focus on five sectors: infra, energy, agriculture, real estate, for social housing / tourism, health, and education. So we do believe in this sectoral approach, and we do believe that the West African Development Bank should be more and more seen as a go-to bank in these 5 sectors, to be seen as an expert banks in the sectors I've just earlier mentioned. Thank you very much.
Great, thank you so much, and you've really outlined quite a lot of innovative ideas and instruments that could be used going forward. And Stephanie, this is over in a sense to you and the researchers to think more about where we need to do additional research to support many of these, the new instruments, and how they could be best used, and to support development banks in those efforts. I think we have only around less than 10 minutes left, and we wanted to have time for questions and answers. So maybe we could put all of the panelists back on the screen, if that's possible. Hi, everybody. And while we're waiting for some cute answers to be shared with us from the audience, maybe I could just ask some of you to respond to some of what each others have said. For example, I would be really interested, Sergio, in hearing your thoughts, if you can, not to put you on the spot, in terms of Nancy's proposals. If you're able to sort of give some thoughts on that, and then we can get from Asha to get over to you for some questions from the audience. So
Absolutely.
maybe for just 1 minute, Sergio, and then over to Asha.
Thank you. I think Nancy's proposals are very interesting, very provocative, and agenda. I do think, and many of us have referenced, and including yourself, Sherry, I mean, we've been 5 years into all of these agendas that guide our work in the different levels, right? In terms of the multilateral development banks, regional development banks, national development banks, subnational development banks, and we have a concrete example from some of our partners, including practitioners such as I am in Serge with BOAD, right? So there's kind of a cascade way, and I think we should relate to partnerships. So what we've been doing here is to first realize that we are not isolated. Despite being a subnational development bank, we are not isolated. So we need to plug in not only into the agendas, but also into the examples, the operational examples, financial instruments that we can tap into and use our good banks as innovation platforms, right? We should do some experimentalism, of course, with responsibility. We do run financial institutions. And in this sense, what we've been doing, other than receiving a lot of support in technology and also in resources, not only financial, but we also been partnering with other banks in Brazil and in Latin America. And more recently, we just signed an MOU with the BSA, with my good friend Patrick Dlamini, the CEO of the Development Bank of Southern Africa. We are sharing with them our digital platform for SMEs.
Great.
We had an engagement during the COP25 in Madrid last year. They were following our efforts and our performance during this year, especially being able to reach the end of the small guy at the end of the line during the pandemic, and now we've been having a series of workshops and close collaboration that is now covered by an MOU we just signed just a few weeks ago. So I think this is a very concrete example on how we can be effective in implementing SDG 17 and linking development institutions of different sizes and different geographies with the agenda that Nancy has referred to. Thank you.
Great, thank you so much. So Asha, over to you for some questions.
Yes,
for the
absolutely. Thank you. Very, very interesting insights here. And we have a couple of questions here, Sherry, and then I'll pass it over to you just to conclude and wrap up the whole roundtable here. So first question here from Susan Engel. So for the panel, innovative financial instruments were the cause of the last global crisis. How have they changed to mean they will be in the solution this time? I don't know if that question could be addressed by anyone would like to jump in there.
I'm sure Stephanie wants to answer that.
Yeah,
so
I can see that.
I think that's an excellent question. I think the challenge is to design financial instruments that help development impact, but they do not undermine financial stability. And one example that Bruno gave, and that Sherry and I agree a lot, is, for example, state contingent instruments, so that they become easier to pay when the economy is doing well, and they get some relief when the economy is doing badly. So this is the kind of instrument which I would say are good for development banks and for their development impact. On the other hand, I worry about the instruments which are, for example, not well-structured securitizations. They may have a role, but we don't want to go precisely down the path that led to Lehman Brothers and the financial crisis in 2008-9. So I think when we're thinking of, for example, how to save fiscal resources, we shouldn't just think also about the short-term impact, but also about the long-term impact. Because if you do things cheaply from the government point of view, but you are creating contingent liabilities where the chickens may come to roost in 15 years, then you may be creating a bigger future problem.
Thank you. We can probably take there's one question I think is a little bit provocative. I want the person asking the question about development banks, are they fit for equity business? Banking is about covering risks. Equity investment is about taking it. How could a public bank have that dual vision unless they specialize a team for capital risk? So I think that's an interesting question. So who would like to take it? Yes. Yes, please.
I think that's an excellent point. You can't just tell an officer that's been doing senior lending for for 20 years for his or her career to start doing equity investment successfully. And especially the kind of equity investment I was talking about, which is early stage equity investment, which is difficult in advanced countries, let alone in poor countries. So I think development banks are confronted with a choice, which is either they develop the skills and the tools inside their institutions on their balance sheets to do this effectively, which means taking a lot more risk and having more volatility in their returns, or they create something off balance sheet, which allows them to put these more subordinated products off balance sheet in combination with their more senior products. So my proposal on the stretch fund is the latter, because I think it's going to be very difficult for the shareholders of these institutions, which are after all governments for the most part, to, at least in the short term, accept institutions that are much more risky and more uncertain with respect to their returns. Because one thing we really have to remember is that a lot of the equity that is put into these development banks over time is actually the retained earnings of the institutions which add to their capital. So shareholders face a choice of either accepting a lot more risk and lower returns, and therefore making it more difficult to expand these institutions, or creating something off balance sheet. But it is a choice that I think now confronts them inevitably at this point. I don't think they can avoid this choice during this period of very much heightened risk and very much essential counter-cyclical activity.
Right. Thank you. Thank you for sharing. Another question here. How can development banks address on a timely basis and an impactful way the recovery of post-conflict settings? I mean, humanitarian, development gap, and contingent. So, right. So how can what role can development banks play there? Tricky question. Anybody jump in there? I think one. Yes, I think I can see. Yes, Sergio. Please go ahead.
I will try to use an analogy. We of course don't have the direct experience of post-conflict situation, but we do have two experiences of post-tragedy, natural tragedy situations. So we had here in Minas Gerais, and I think some of you are familiar, two ruptures of mining dams, very large ones.
Absolutely.
That have destructed several municipalities. The first one 5 years ago, and a recent one with a very large human tragedy, killing dozens of people, and really leaving the ground as if a conflict had existed. So the analogy is that you do have a region with several municipalities and displaced people, and we have partnered with the foundation created by the company that was responsible for this raptor in creating programs, several programs to first mitigate the effects, work on water and sewage treatment for, in our case, it's 35 municipalities that were affected, and also creating programs to attract larger investments, but also to finance with special conditions, actually concessional loans for SMEs, so that people who are there can sort of restart their businesses that were completely destroyed, or even go into a new business if their previous activity is no longer possible. So I do think there is a role for development banks. Actually, this is at the heart of the creation of development banks. If we look at 1944, the spirit of Bretton Woods, and bearing in mind that the first loan from the World Bank was to rebuild and reconstruct France.
I think that's brilliant to answer part of the question. Sherry, I think we have less than 3 minutes. I would say 2.5 minutes for you just to wrap it up and just conclude this panel discussion, which was great, by the way. As I was telling Sebastian this earlier, that it's hard to manage a panel like this by not seeing each other. So it's very challenging. Good job to all of you. Just Sherry, over to you for the wrap up.
Great. Thank you so much. Thank you, Asha. And thanks to all the panelists for the really interesting and very insightful comments that I think have really highlighted the important role and the potential for using innovations, but also the risks in doing so. You know, I really was listening when I was listening to Nancy's comments about the use of equity instruments and the different possibilities. As somebody who used to invest in markets and even invested through other funds, no matter how it's done, the capacities have to be in nationally and in the local banks as well. Even if it's outsourced, you need to have capacities in the house to better really understand where their money's going. So one of the really important lessons is going to be, as we build up and continue to use more and more complicated instruments, is really both understanding risks and building capacities in-house. And this is why groups like the IDFC, and this conference are really so critical, because by bringing together different development banks and bringing together different from different regions and different mandate and different types of development banks that also different from countries at different stages of development is really an opportunity for people to learn from each other, because ultimately, no matter what instruments are used, lessons from the global financial crisis, when we think about securitization, can these instruments be used in ways that are going to overcome some of those past risks? You really need to have the capacities to do that. And so it's more important than ever for everyone to be learning from each other's experiences, which is why this is such an important, really critical initiative. So thank you so much. Thank you to the panel. And I look forward to hearing from all of you in the future, learning more. And Asha, back to you to conclude.